Welcome everyone. We shall be covering strategies to succeed in positional trading in this webinar. Myself, Amar Singh from Angel Broking. So, I will be the structure of this webinar is going to be that first I'll be talking about the importance of technical analysis, and then I will be talking about the decision-making tree, how to come to the right choice. Uh, what are the factors that you definitely need to consider while taking a trade, and this is more from a positional trading that I'll be talking about. Then briefly I'll be touching on strategies, what are different types of strategies, what's swing trading, what's trend trading, what's counter trend trading, and fourth and most importantly I'll be talking about how to be a professional in positional trading, in position trading. So these are the four areas that I will be covering in this webinar. If we look at the first area, importance of technical analysis. So what you need to understand is that what you need to understand is that charts are a window into mass psychology, and technical analysis is a study of charts. So when you are looking at charts, you must understand that you are actually analyzing mass psychology, because it is the all the market participants, how they are reacting or how they are acting, how they are behaving at any given point of time. That's captured in the charts. So when you analyze charts, you are actually analyzing the behavior of trading masses. And the behavior of trading masses has not changed. We are governed by the same, I would say, emotions such as fear, greed, and hope. So the technical analysis tries to capture all this in charts. And apart from that, market prices are leading indicators of fundamental information. So that's one of the reasons why the market is called a discounting mechanism. Many a times you will find that the market is rallying, but there is no fundamental news, or the market is correcting, but there is no major news as to why the market is correcting. But somewhere some information is already there, which is being factored in the price at that given moment of time. So you might not know the exact reason why it is happening, but you will know through charts and technical analysis that something is happening in the markets, and you could act on it. You could have a first mover advantage if you are using technicals. So the price trend of a market revealed on a chart tells us a lot about its fundamentals. So generally, what you need to understand here is that technical analysis works best on liquid stocks. That is where there is a good amount of buying and selling, large number of market participants. The more the liquid the stock or the index or the commodity or the currency or the equity is, the better it will react to technical analysis, or the better will be your analysis on technical analysis, because that will mean that many market participants are there in the market. So that will help you uh, gain edge over others. So if the technicals are bad, the fundamentals are probably as bad. So if a stock is falling significantly, then you will find that the fundamentals are also bad. Maybe they have not come out yet, but they would come out slowly and slowly. So I'll tell you how to look at the markets, how to look at the charts from that perspective. And if you are looking for market with good fundamentals, find one that's in an uptrend. So if the stock is in an uptrend, generally you'll find that there are some good fundamentals that's aiding it. So the fundamentals are the driving factors behind any stock, either up or down. But technical analysis helps you capture that and take advantage of it. And the other major advantage or importance of technical analysis is that once you have a good grip on technical analysis, then you can work across the globe, across countries, major indices, across asset classes, also across time frames. So technical analysis works across all time frames, works across all major asset classes, be it equities, commodities, or currencies. And by global, I meant was that if you understand technical analysis, then you'll find that it works well in the U.S. markets, European markets, Asian markets, Australian markets, Japanese markets, any market which is free and which has a large and active market participants. So you see that to succeed in markets, that is, you can succeed in markets only if you handle it as a serious intellectual pursuit. Meaning that if you want to invest in the markets, then you have to be serious about it. Emotional trading is lethal, it's dangerous, and a good trader watches his capital as carefully as a professional scuba diver watches his air supply. So, what you need to understand here is that if you are investing in the markets for a long term trade, it's not that you should simply buy the stock and just hold it without any stop loss or without any view as to what you will do if the stock goes against you, because we see stocks every day either correcting by a significant percentage or rising by a significant percentage. So that is something which you need to. If you look at the pharma stocks, what has happened in the last couple of years, many of the blue chip pharma companies have more than halved or become one third the value which they used to be a few years back. So just because they were blue chip companies and top companies at that given point of time did not mean that you simply have to buy and hold. So technical analysis can give you early warnings if you're looking at the long-term charts, be the weekly charts or the monthly charts. So it can give you early warnings that something is not good in this stock or something is happening in the stock and it's just time to exit. So that's a major advantage. And just as a trader has to study trends and reversals in the market, the way a sailor studies the ocean. If a sailor is sailing on the ocean, he has to be aware of the weather. He has to be aware of the wind and all that. So similarly, a trader or an investor who's there in the market using technical analysis, he needs to study trends and reversals. And what you need to remember is that you can never control the market, but you can learn to control yourself. So generally, what happens is we try to control everything or everyone else except ourselves. That's the reason we fail in that endeavor. What we need to understand is that we have control over only ourselves or our actions. So if we can learn to manage that, we will be far ahead. So success in the markets stands on three pillars. You need to analyze the balance of power between the bulls and bears, that is using technical analysis. Who are more strong? Are the bulls more strong or the bears more strong? So technical analysis can tell you for if you're investing from a long-term perspective. Anyways, if you're short-term trading, anything, you need to practice. The second is you need to practice good money management. You might have a very good strategy, but if you don't have a good money management policy as to how much to risk, I'll be talking about that in detail going forward. So what you need to remember is that you need to first of all understand technical analysis. You need to practice good money management, and you need personal discipline to follow your trading plan and avoid getting high or depressed in the markets. Generally, what happens is that if you miss a trade and the trade has been going in your favor, or say for example, you were bullish on the metal stocks, say for example, Tata Steel, Vedanta, but somehow you were not able to buy the stock and the stock rallied. So maybe you are feeling depressed or you are feeling left out. So you have to get over those feelings because the market always offers opportunities. It's for us to understand and grab those opportunities. So you need to have personal discipline to follow your trading plan. So now we come to the next important aspect of this webinar is the decision making tree. How to make the right choice, how to really know what to do from a positional trading perspective, from a long-term trading perspective. So this is something which I call the ABC system. So it's quite simple. I will be able to explain to you, so you can be rest assured that you have a very good understanding and knowledge by the end of this webinar. So this ABC system calls for a quick weekly review of all the stocks that you track and sort them into three groups. So basically, this is something you don't have to do it on a intraday basis. You have to look at it on a weekly basis, and then I'll be talking about more in detail. So this ABC system is first is A is for those stocks you might think to trade tomorrow. That is that is, tomorrow you might get an opportunity. So I'll be talking about that. B is for those who might think to trade later in the week, and C for those who do not expect to trade in the week. So this ABC system basically helps you categorize the stocks which are ripe for investing tomorrow, which you could get a buying opportunity in the week, or which you do not expect to trade in this week. So the best time to run the ABC system is on weekends, because why is it weekends? Because it's after Friday, you have the entire week is over, so the weekly charts are also up for you, and you can have a better view. So you can do it on weekends, and the best part is the emotions, because when the markets are open and you are having buy and sell, and you are taking buying and selling decisions during market, and the market is trading. So that time you could be very emotional. But if the markets are closed and you are looking at the charts at the end of the day or over the weekend, you would not be that emotionally moved. So that's a major advantage. So now we look at, first of all, the ABC system. In the AB system, what we see is, first we see the monthly chart. That you always need to understand is that always start from the long-term view. Don't ever go down to the short-term view, because in this ABC system, what we are doing is we are first looking at the monthly charts, and in the monthly charts, we are seeing as to how the overall chart is performing. So here what I am using is that there are certain indicators you can see in this chart, and this is a Hindustan Unilever chart which is there. This is a monthly chart of Hindustan Unilever. Each bar represents 1 month of data. So you can see for yourself that there are primarily two indicators that I'm using. One is moving average and the other is MACD histogram. So the moving averages which I'm using are 10, the green line is 10, and then the red line is 20, and the white line is 30. So basically, I have plotted these three moving averages, and I'm looking at the slope of these moving averages. And apart from that, on the MACD histogram, the next below indicator, you see that there is a zero line, and there is above the zero line and below the zero line. So now what we are seeing is that for the last almost 8 months or so, uh, Hindustan Unilever has been positive on the monthly charts. And if you can look here for this particular matter this year, so what you see here, this is a major resistance level. Earlier 950 was a major resistance level, then this level was taken out, and there from 950 it has rallied significantly. So first of all, what you need to do is you need to look at the monthly chart of the particular stock. Okay, then you will know that, okay, this is strong on the monthly chart, so any major dip I can use as a buying opportunity. So this is for positional trading. This is not, you need to use this for intraday trading or short-term trading or swing trading. It's not at all required. If you are looking at a positional trading, which could be a few weeks to few months also, and or few quarters, then this is what you should use. So first of all, you look at the monthly chart. So when you look at the monthly chart, you know that, okay, this Unilever is in an uptrend. So I will be looking at buying opportunities. So these are the stocks that you will be looking at during the month for opportunity. So once you've identified, okay, these are the stocks which are in an uptrend on the monthly, so you identify those stocks. And this exercise is to be undertaken at the start of the month. So you need to focus on the liquid stocks. Don't look at illiquid stocks, which are not where the volume is very less, or the bid and ask spread is very high, or the stock has been hitting upper circuit or lower circuit. So these are the type of stocks, the typical stocks which you should avoid, because those don't work well on technical analysis. So for technical analysis, one of the major requirements is that the stocks have to have a volume. There has to be liquidity in the stocks. There have to be a large number of participants in that particular stock. Then technical analysis works best, because that makes the stock to trade properly, and technical signals are also better in such stocks. So the first screen is your monthly screen, wherein your monthly chart, wherein you see that in Hindustan Unilever, here we are seeing that the overall MACD histogram, that's positive and it's above zero line. This is a zero line, so it's positive and it's increasing. So if it's increasing, that's even better, meaning that the trend is gaining in strength. And here you are seeing that the moving averages, be the 10 period or the 20 or the 30 period, they are all sloping upwards. So you can be rest assured that any correction can be used as a buying opportunity. So I hope this screen is clear. So now we move to the next screen. So here what we are seeing is that this is the weekly chart of again we are seeing that on the weekly chart we give more importance to the moving averages on the weekly chart and less importance to the MACD histogram readings here. So here we can see that MACD histogram readings are slightly negative, and but the overall trend on the weekly, this again is a 20 period and a 30 period. I'm not using a 10 period here. I'm using a 20 period and a 30 period exponential moving average. So I can see that the slope is up on the weekly charts. This is an exercise which you need to do on your weekend, so you don't have to so people who don't have that much time to spend during the day, this is a very good exercise. You can do it on a weekly. So now first of all what you've done is you looked up for those stocks which are strong on the monthly charts, and then you look at those stocks which are those stocks on the weekly chart, and in the weekly chart you find that okay, this stock is also in an uptrend, so any correction I will be using as a buying opportunity. And this study you can do on weekends, and this is where you get your entry points. So here we are looking at the daily chart. So on the daily chart you find that I'm not using any of the indicators which I was using in the weekly chart or which I was using in the monthly chart, because daily chart is going to be my entry point. So in this what you can, and the best part is daily chart also you don't have to look at it during the day. At the end of the day you can look at all those stocks which first of all qualified on the monthly and the weekly, then you'll find that they are a very small set of stocks. So at the end of the day you can look at those stocks, and this is, and these are two indicators that I'm using. One is a Bollinger Band. So here the period is 20 and the standard deviation is 2. So basically the parameters are 20 and 2 for Bollinger Bands. So this is the green is the upper band and red is the lower band. So and this the second indicator which I'm using is the stochastic. So here I'm using a slow stochastics and the period is 14 period. So this is a 14 period slow stochastic. So and this is a 20 value, and this is an 80 value. So below 20 is oversold, above 80 is overbought. So now what I do is that I go back to this earlier chart. So what we are seeing is that and I go back to this earlier chart. So now what I'm seeing is that from August onwards last year. August onwards last year, this Hindustan Unilever was in an uptrend, because it was, if you look at this during this period, it was completely trading sideways between 800 to 950 or so. But in August and further on in September, it started trading upwards. So that means the trend is up. So now I'm looking at the weekly chart. So weekly chart, the trend is also up. So now, and we are somewhere around here. So there has been a major rally. So this also is a move which we could have captured through the daily charts. But we'll just take a recent example. So here what has happened is that this was somewhere in October of 2017, where you're finding that the stock closes below this red band. You can see here that the stock closes below the red band, and the next day the stock closes above the red band. So, and you're finding that this is in an oversold territory. Since it is below 20. Some people use 30/70. I'm suggesting 20/80 because that gives you more tighter parameters. So what we are seeing here is that on this day, uh, Hindustan Unilever closed below the red band, and on this day, the next day, Hindustan Unilever closes above the band. So the break off, so what you can do is end of day you've seen this, okay, so you've seen that it has closed. Now once the high of this day, so you can say that okay, you can place the order that once the high of this day is reached, the recent low which is there, that can be used as your stop loss. Below that you can have your stop loss. And you see that from almost 1190 levels, in the next few days it rallied by almost 10-15% to 1280 1300 levels. And then it continued its rally, and you can see that after October, it has not given another buying opportunity. It's more that it's on the higher side only. It has been trading. So what you can do is you can use this as a very good strategy for all of you who are on this webinar, to see for yourself, to practice for yourself, identify for yourself. And you can also write to us if you have any queries at webinars@thelateangelbroking.com. We will address your queries. And you can use these tools you can use. There are various websites which are available. If you are a user of Angel's Speed Pro application, then you can activate advanced charts, which is a very good charting application which has all these indicators and everything available. And you have data going back to as many as 20 years also in many of the stocks. So you can use that in Angel Advanced Charting application, but that's available only in Speed Pro. So those who are active on Speed Pro, they can use that. For the rest, they'll have to look at some other websites where they can get this such information. So I think so far it's clear. And what you can do is you can also use the upper band as your target price. So if you're buying somewhere around here, that's 1200, your stop loss is somewhere below 1170, and then you are having a good run up here, almost a 10% rally which has happened. So these are the trades which you can take, or you can continue holding for a long period of time. And if you've seen that, then the stock has rallied significantly from there. So this I've taken just one example of Hindustan Unilever. You'll find that this strategy works in most of the cases. Where it doesn't work, your stop loss is going to protect you. That's the best part. And these are trades which are, I said, spanning weeks and months. So that's one major advantage. So this is a system which you can use, a strategy which you can use. And if you have further queries or want to understand or want to gain further understanding of this, please write to us at webinars@angelbooking.com. So now we look at some of the strategies in swing trading, trend trading, and counter trading, counter trend trading. Swing trading, basically, I'll not be talking much, because swing trading is more of a short-term trading wherein you are actually your entries are based on hourly charts, so your positions are generally for a couple of days. Trend trading is what is majorly positional trading, wherein you are identifying some strong trends and you are riding those trends. And counter trend trading is basically that you feel that the trend or the stock has moved up significantly. So now it is ripe for a correction. So you go again against the trend and you sell the stock. So that is a strategy, but you need to understand that whichever strategy you're following, you have to have your stop losses defined, because that's what's going to protect you if the trade goes against you. So we'll just look at some of the popular technical tools to identify trades. And markets are so complex that we must analyze them in more than one time frame. So, for example, if you are a long term, if I would say this is for the likes of traders who are holding on to their positions for not for months, they are holding their positions for years. For them, they can look at the yearly chart, they can look at the quarterly chart, and they can look at the monthly chart. So for them, the long term is a yearly chart. So what it means is that every bar represents 1 year of data, 1 year's open, high, low, and close. Likewise, the intermediate term or the medium term trend, medium term chart will be quarterly. Just to explain to you, here what we are seeing is that the monthly here becomes long term, the weekly chart here becomes intermediate term or the medium term, and the daily chart becomes the short term. So, and your entries are on based on how on the basis of short term. So if you are a very, very, very long term trader, then you can have a look at the long term yearly charts and quarterly charts and the monthly charts. Otherwise, you can look at a quarterly chart and a monthly chart and a weekly chart. Or what we were discussing was the monthly chart, the weekly chart, and the daily chart. This is ideally best suited for trend trading, for counter trend trading, and this is something which you can very well use. For counter trend trading, you have to have some very valid reason as to why you're going against the trend or why you're going short. It could be because the stock has reached a major resistance level or a major previous high or a top has been reached, so the stock is likely to correct. Or maybe you're seeing some bearish divergence in the stock, or maybe you're seeing that there is some bearish candlestick pattern formation on the chart, and also there is bearish divergence. So if there are some of these indicators which are there, then you can still go do a counter trend trade. But always remember that your trades must have a stop loss, must have some restriction on the risk that you are taking on a particular trade. And then further, as we go down, then those who are trading swing trading, for them it's weekly, daily, and hourly. And intraday is very short term. So I'll not be talking about them. You can have a look at it at your if you so wish. In this presentation will definitely be made to all of you, so you'll have an access to this presentation. And the positional trading, if you look at the positional trading which I'm talking about, the secret is out. Basically, what I mean here is that if you are able to look up and understand what is the slope of the EMA which I talked about, and then you look at the slope of the MACD histogram, whether the MACD histogram is positive or increasing or negative or decreasing, what is it? So if both are up, that is the slope is also up and the MACD histogram is also up, that is green. That's mean that's a very strong signal. That means you should ideally go long or stand aside, but no shorting. That is, you should not short. You have only one thing that you can do is that you can go long, otherwise you do nothing. Then if we see that the slope of the moving average is down and the MACD histogram is also down, so in that case that becomes a red signal. So what it means is that you can go short or you can stand aside but no buying. You'll find that many of the pharma stocks which have corrected significantly, they were always or significantly for many months they were in the red. So they were correcting and correcting and correcting. And those who were buying them, that this is a very good level for this blue chip stock, or the stock has gone down only 30% or 40%. That was not a good idea. So technicals can help you protect yourself. And if you're finding that the moving averages are moving up, but the MACD histogram is down and negative, and likewise the moving average is moving up, moving down, but the MACD histogram is up, that is positive. So that means the markets are going to trade choppy, sideways. So you can either go long or you can go short. So that's why the color mentioned here is blue. So when it is green, that is the best. Those would be the best stocks to trade, and those who are in the red category, they are the best stocks to sell. So I hope I have clarified so far. Now we will look at to be a pro in positional trading. If you really want to become a professional in positional trading, then what is it that you really need? First of all, what you need to understand is that to be right and to sit tight is the toughest thing to do. But this is the only way to make big money in the markets. If you look at your trades which you have taken so far, you'll find that there have been many trades wherein you book profits early and the stock rallied so much that had you held on to that particular trade, you would have made a lot of money. But the urge to book profits is very high as compared to the urge to book loss. We generally are very slow at booking losses, but we are equally fast at booking profits. So there's a very nice saying which says that when we are in profit, we become a trader, and when we are in loss, we become an investor. But the people who successfully trade the markets, who successfully invest in the markets, are the ones who do the opposite. That is, if they are having losing trades, they will get out of those trades fast, and if they are having winning trades, they will then attempt to ride those trades as far as possible, because that is where the big money is made. So the big money is never made in your thinking, it is always made in your sitting, when you simply buy and hold a stock which goes in your particular direction. And then you definitely have an exit mechanism. So I'll be talking about that as well. So the second point, what you need to remember that if you want to become a pro is that you cannot make money if you're not willing to lose money. It's like willing to breathe in but not willing to breathe out. Say, for example, there are people who are saying who say that no, I don't want to lose money in the markets, I don't want to lose money in the markets. What is ultimately going to happen is that they are going to be driven by the emotion of fear, the fear of losing money. So once someone is driven by any fear or any emotion in the market, then that person is no longer a rational being. Then he will take irrational decisions, he will take emotional decisions, which is not good for his financial health. So you need to understand that it's a game. Like you're playing cricket, so you could be out on a first ball, or maybe you could hit a century. So those things are part and parcel of the game. So same is with the markets. If you're taking trades, some trades go right, some trades go wrong. You have to learn to manage them. But at the same time, you have to ensure that you don't lose big money on any particular trade, which can seriously damage you financially. So the next point, what you need to remember is in order to become a pro is that falling markets must never be viewed as places to buy cheap unless confirmed by technicals. So just because a stock has say fallen from 500 to 400, it's not a sufficient reason for you to buy that stock. You should look at it through the screen of technical analysis. What is technical analysis telling about that particular stock? So the more you look at the charts, the better you become at it, and the more you can keep your emotions away from the charts, the even better you become at it. So you will know that you are becoming a pro, that is a professional, when you start spending almost as much time thinking about exits as looking for entry. This is something which is very crucial, because generally what happens is that majority of the people, they simply want to know what to buy and when to buy. That's it. They are not interested in knowing when to exit. So when you start questioning, okay, that if I take a trade, when will I exit this trade? If I'm in profit, when will I exit this trade? When I'm in loss? That means that now you're on the path of becoming a professional trader. But if you're just concerned with, oh, where do I need to buy? Where do I buy? Where do I buy? That means becoming a professional is a long way for you. So this is something which you should definitely. So these are some very key areas which all of you should work on. Then the next is that quiet markets put amateurs to sleep and gives the professionals a chance to run away with the market. Many a times you'll find that the stock is not doing anything, it's consolidating, trading sideways, and then one fine day the stock rallies like maybe 8%, 10% in a single day, and then people are saying, oh, the stock it didn't go anywhere for so many months, but now it suddenly rallied. Now I don't need to invest in that stock. But maybe that could be the time, that could be an opportunity to invest in that stock, because the stock has broken out of a consolidation range. But at the same time, you have to ensure that and check whether it is supported by exceptional volume. So if that is the case, then the probability of the stock rallying further is high. So these are a few areas which you definitely need to think in order to become a professional. Then this is something again which you is this is more specific, I would say. If you really want to become a professional in positional trading or any trading or investing, these questions you have to ask yourself. So first I will be talking about the market related questions, that is which stocks to buy or sell. As which stocks to buy or sell, I talked about it, the ABC system. You can use it to identify which stocks to buy or sell. Then the next question comes is how many stocks to buy and sell. Just now, say for example, you have come to the conclusion that you need to buy Infosys, you need to you need to buy Tata Motors. Just this is just a hypothetical example which I'm giving, or you need to buy Bharti Airtel, or you need to buy Reliance. But the big question is how many stocks, how much quantity do you need to buy? That is something which a professional understands. So say for example you have a corpus of 1 lakh now, and you want to buy Tata Steel. Will you go and buy all the entire money you will buy Tata Steel? No. You have to diversify your portfolio. That's something which is very important. So as a professional, you will think about how much quantity you will buy, then when to buy or sell. So when to buy or sell, that technicals will help you. Then the next question which you have to ask yourself is, if you really want to become a professional in positional trading or intraday trading or short-term trading or an investor from a long-term perspective, when to get out of a losing trade. So if you are in a losing trade, when do you get out of that? Next is when to get out of a winning trade, because as I said earlier, if you jump out quickly of a winning trade, you might lose out on the big profits that you would have made. So the question is when to get out of a winning trade. And the last question is how is equity curve moving month on month? This is something which I would advise all of you who are seriously in this investing business and really want to grow as to what is the total corpus, what is the total amount of your portfolio at the start of the month, at the end of the month, then at the end of the next month, at the end of the next month. So you will see that how that has been moving. If there is too much of jagged means crisscross lines or very means volatile chart is there of your equity curve, that means you are primarily trading on your emotions, which is not a good thing. But if your equity curve is sloping gently or declining gently and then again rising up, that shows that you have some process or procedure to invest. So this is something which is very crucial. Then the next that's more related to the markets. What is related to the self, that is what is related to you, that also is very important. You have to ask questions such as what is my nature and how well I am suited for trading. That's what's your basic characteristic trait. Then how much money do you want to make? That's again is a question you have to ask yourself. What is the sort of returns that you're looking at? What level of effort am I willing to make to reach my goal? So if you want to say, for example, generate returns in excess of 20% or 30%, whatever, then you have to put in some x amount of effort. So are you willing to make that effort? Then the next question which you need to ask is what, if any, is my investing or trading experience? Do I have any experience in investing? Do I have any experience in trading? If I don't have, then how can I increase my knowledge? How can I meet with people who have more experience and how can I learn from them? And lastly, what's very important is what are my strengths and weaknesses and how I plan to work on them. When there are certain strengths in us, there are certain weaknesses also. So the weaknesses do us harm, the strength that basically does us good. So how do we manage both of them so that we are in harmony, and then we are able to successfully trade the markets? Because as I started, that markets are emotional. Markets are because we are emotional beings, so the market is an emotional place. But trading successfully does not entail, that is, there is no place for emotions in trading. That's the major difference. That's the major issue. That's the major challenge which separates the professionals from the amateurs. The professionals realize that there's nothing right or wrong. It's just a trade. The trade can go in profit. The trade can go in loss. If it goes in loss, they ensure that it is not a very big loss. They can come back in the game once again. But amateurs are they become very touchy, very emotional. If they take a loss in a trade, then they beat themselves. If they make a profit, they are very happy, and that means they are trading their emotions. So trading emotional is very lethal, very dangerous. Somewhere you have to become objective. Somewhere you have to develop a rationale. Somewhere you have to have some logic for why you are taking a trade. If you follow what I have shared in this webinar, I believe that you could definitely enhance your results, enhance your investing approach, and it can really do wonders for you. So if you have any further queries, you can write to us at webinars@angelbroking.com as well. So lastly, I would like to just talk a bit on the psychology, the odds against you. The trading is a battle. When you pick up your weapon and put your life on the line, would you rather be drunk or sober? Trading is a very serious business. So if you are non-serious, then the markets are not a place for you. And the mental baggage from childhood can prevent you from succeeding in the markets. The thoughts that we have are something which matters. Like suppose some people say, oh, I'm never lucky. Whatever I buy, it falls. So I don't make money in the market. So if the person is thinking along those lines or she's thinking along those lines, then that becomes a self-fulfilling prophecy, and you'll find that he or she is engaging in such positions or taking up such positions wherein the probability or the possibility of making money reduces significantly. Then the next is you have to identify your weaknesses and work to change. And apart from that, you need to keep a trading diary. You need to note what are the reasons for entering a trade, what are the reasons for exiting a trade. Look for repetitive patterns of success and failure. Why is it that some trades worked well? Why is it that some trades didn't work well? What was the common understanding from them? And if you can go to that depth over a period of time, you improve significantly, and then you are on your path to become a professional. and a very successful investor. And lastly, trading is a journey of self-discovery. If you, because as I said, it's all about understanding our inner weaknesses, what our strengths are, and then working on them. So with this, I conclude the webinar. There's one thing I would like to add is that we have, as I talked earlier, also we have this Angel product, Angel Advanced Charting application. This is in Speed Pro. So those who are interested, they can write at ebroking@angelbroking.com, mention your client code and request for activation of Angel Advanced Chart. It will get activated, and you can view all the charts, all the indicators which I talked about this in this webinar. And at the same time, you can also refer this presentation once you are on the charts, you're looking at the charts, because it can really make a significant difference in your investing or trading style. And can, the best part is it can protect you, protect you against major movements in the market, because technicals are leading. So at many times they will help you protect yourself. Thank you.